Okay, is up,
Okay. Well,
please.
thank you very much, ladies and gentlemen. Welcome to all attendees to the international webinar on hotel investment in emerging markets. I'm delighted to know that there are folks all over the world watching this seminar at this very moment, and we hope to have speakers from and panelists from New York all the way through to Sydney, Australia. And so good evening, good morning, wherever you are. Welcome to this webinar. I'd like to welcome in particular people who have joined us through Zoom and also a number of other platforms. We have people who are listening on Facebook, Instagram, YouTube, and other websites. And I should say at the outset that the PowerPoint presentations that are being presented this evening or this morning will appear on the website together with a recording and the biographical details of the panelists tomorrow. So you can avail yourself of that. I'd also like to thank Dr. Reza Sultani from the Institute of Tourism for organising these wonderful webinars. I've attended two of them in the past, and I truly appreciate it. And I know there are many thousands of people who have sought information and collaborative efforts on the part of their particular interests in these series. So today we're talking about hotel investment in emerging markets, everything you need to know. And I've been able to seek the services and the time of some very distinguished guests, and I'd just like to introduce them to you. We have a guest, Fanadi Uriati, who is the director from Cross Hotels and Resorts based in Thailand. She was also a business development manager for Southeast Asia for STR. And she brings over 13 years of experience with global hospitality and real estate brands such as Mandarin Oriental Group and Raffles Hotel Singapore. She's an accomplished presenter and thought leader, and Fanani regularly shares insights on the latest hospitality and tourism trends across major industry events in Southeast Asia. Stella Blythe joins us from Singapore. She is a director of hotels and hospitality, capital markets at CBRE Asia. She is an award-winning professional specialising in investment sales, particularly hotels, across the APAC region. She was honoured in 2024 Rising Star Award by the International Society of Hospitality Consultants and HICAP. And Stella brings extensive global experience in hotel advisory, real estate investment and valuations, with a proven track record of excellence in transaction and client solutions. And I had some professional dealings with Stella a few years ago, just at the end of the COVID-19. Trevor Ward. Trevor is a leading hospitality and real estate consultant, has over 3 decades of experience advising clients in developing countries with a primary focus in Africa. Based in Nigeria for more than 20 years, Trevor is widely regarded as one of Africa's foremost hotel industry experts and is recognised for his work across 40 African nations and his contribution to the global hospitality sector. Mihir Sharma, as the CEO of Sigmund Hotels and Resorts, is a seasoned hospitality leader with 24 years of experience driving growth and innovation in the industry. And under his leadership, Sigmund has achieved global recognition, expanding across India, mainly India, the UK and the Middle East, solidifying its position as a dynamic force in the hospitality sector. I'm not quite sure whether Nick Lower has joined us yet. He's the National Director of Hotels at Savills. Is a highly accomplished real estate professional in Australia with a decade of experience in hotel sales, advisory and development. And he's been involved in a number of highly complex transactions and developed investment strategies for investors. So that's and Dan Lesser. I'm not quite sure whether Dan has joined us at this stage. Maybe because he's based in New York, he might be a little late, but it's very early in the morning there. But Dan Lesser is the president and CEO of LW Hospitality Advisors. Is a globally recognized expert in hospitality real estate with over 40 years of experience in appraisals, feasibility studies, asset management, and transactions. A thought leader and sought-after speaker, he holds esteemed designations in a number of organisations and is widely respected for his strategic advisory and valuation expertise in the hotel and resort sector. And Dan, like Trevor, is widely regarded as one of the foremost hotel industry experts in the US. So with that, I would like to spend a little time, having introduced the speakers, talking about the context and significance of this particular webinar. And I want to also discuss briefly just the definitions of what emerging markets for hotel investment are. Essentially, an emerging market in the context of hotel investment refers to a country or region that is transitioning from low income, less developed status towards a more robust industrialized economy with increasing integration into the global market. These markets are characterized by rapid economic growth, improving infrastructure, and evolving regulatory environments, which collectively create new opportunities and challenges for hotel investors. I just the key characteristics of emerging markets for hotel investments: economic growth. Most of these emerging markets are exhibiting higher GDP growth rates compared to developed economies, driven by industrialization and urbanization and a growing middle class. And here in Indonesia, where I live, that's certainly the case here. Indonesia's GDP has been 5 or 6% over the last few years. This economic expansion increases disposable income and domestic travel, bolstering demand for hotel accommodations. Demographic trends are also a key feature of these emerging markets. A youthful and expanding population in these markets contributes to a rising number of travellers seeking leisure and business accommodations, thereby enhancing the potential for hotel investments. And that's certainly the case here in Indonesia. I know it's the case in many other emerging economies in Southeast Asia and Africa. Infrastructure development, significant investments in transportation, utilities, and tourism-related infrastructure, improved accessibility and attractiveness, making these destinations more viable for hotel development. And finally, market volatility. It's interesting that many of these emerging markets may experience higher levels of political and economic volatility, which can impact upon investment stability. However, they all offer substantial growth and investment potential, attracting foreign investors due to the high return that they provide. So with that, just a little background in relation to emerging markets and their importance. I really want to now turn it over to the panelists, and I'm going to invite Mahal Sharma to lead off the discussion.
Thank you, Ross, for having all of us from various diversified areas, and especially from the emerging markets to be a part of this team panel. I think I got very intrigued a couple of days back when it was suggested
that we don't have your video. Can you turn on your video?
Yeah, sure. Okay. Yeah, sure.
Okay.
We exchange a few notes, and the subject matter was about the hotels in emerging markets. And of course, we represent out of 3 countries where we operate, which is United Kingdom, Middle East, primarily in Dubai and in India. India is one of the emerging markets, so it was a very well thought of subject matter and the contribution. Having said that, I think to the entire panelist and to a lot of participants which are there. The most important thing which I would like to say, because we started off with hotels in India and then we moved into UK, currently managing more than about 1,000 plus apartments, hotels in UK in about 40 cities, and then of course we just taking a few hotels in Middle East. I think the uh, most important role which I would probably feel is that in terms of emerging markets is the contribution of tourism to the GDP of the country, which plays an extremely important role in creating the right impetus from the government for the particular sector itself. I mean, like Ross mentioned, that the GDP of Indonesia, for example, is growing at about 5 to 6%, and considering a contribution of tourism to the GDP, that's where the real growth comes in, especially for a country like India, Indonesia, Thailand. We've seen a lot of dependence in terms of the employment, in terms of generating income, in terms of the foreign direct investment, because in India, of course, it's 100% FDI into the hospitality and tourism. Hence, in the last 3 years, we've seen a huge growth of the tourism sector as far as the hospitality is concerned, especially in India. We see a lot of growth in Dubai. We've just in process of starting few hotels in Dubai and in Middle East. Again, the support which we get from the government to ensure that this particular sector is right up there is phenomenal. But that also talks about the overall contribution, the numbers of people coming in as a country, how well it's generating its income, and how is the finance and the money being hedged into different countries. That is something what plays an extremely important role. So coming back to the questions which Ross had put across, I don't know if that's the sequence which we would follow, but I wanted to start out by saying that we get a lot of support from specific of these governments and the local bodies, purely because of the fact that the tourism is playing an extremely important role, at least in Dubai and in India. Hence, the growth is there. Whether it comes to different models, like there's something which is very country specific called the PPP model, which is private partnership, which the government has introduced, various taxation which has come down, a lot of schemes which has been introduced by the government to only ensure that the numbers are met. Hence, 80% of the contribution in hospitality in India is through domestic tourism itself. And we're not even dependent on the inbound tourism, which is a very healthy sign for a lot of countries like Indonesia or Thailand. Of course, they are dependent on a lot of outbound tourism, but at least for India, it makes us absolutely self-sufficient. So coming back to the subject which was laid upon, I think in the emerging markets, backed by a very strong policies of the government, backed by a strong travel stability in the government, which is something which we've seen a very strong shift of people traveling from an XYZ countries back into safer economies, is the key thing. And this is where the tourism and the growth and development. I saw some points mentioned by one of our colleagues in terms of the expansion and the hotel signings in the emerging markets. So it's a very healthy figure to see, because there are multiple signing which is crossing about $3 billion, at least in India, in terms of hotel developments and new brands coming in. That's the growth which is being charted out, which is where the future lies. So having said that, Ross, I mean, I just wanted to start off on an introductory based on the subject, which is extremely close to everybody's heart, because that's where the entire growth and focus is, and especially in the emerging market, because we realized in a couple of places across the globe, there are very few countries which is actually growing the way it should grow in terms of the GDP. And of course, tourism is contributing, at least in India, for example, it's about 10 to 12%. Dubai, extremely good numbers. We're doing an average occupancy of about 96%. It crosses about 24 million people coming in, fourth most visited city globally. That's where the growth is happening in economic stability, viability, ease of doing business, taxation, policies, all of them are helping for the growth in this particular areas. So that's a little opening remark from my side. And over to you, Ross.
Thank you, Mahil. I truly appreciate that. I'm going to keep questions directed to panelists after each of the panelists have spoken for 5 or 6 minutes. Then we'll come back, and I've got some questions in relation to government policies, particularly in
yeah.
So, okay, thank you very much. A wonderful presentation. Thank you. Stella, it's in your court now.
Stella, please unmute yourself. Stella, you're muted. Okay.
Okay. Can you all see me and hear me?
Yes, we do.
Yes.
Perfect. And thanks so much for that introduction, because you know, in terms of the regions that I cover, it is Asia, but I do find that I focus sort of on the emerging markets, probably less so than some of the other panelists that we have. But I'm hoping that my sort of macro overview will still provide a little bit of insight. And again, thanks so much, Ross, for hosting. It's very rare these days that you get such a global audience. We're normally just sort of speaking to, you know, people from the same region, which half the time they already know what you're going to say. So it's really nice to have a global audience. And thanks everyone for joining from all over the world. I know it's very early for some of you, and I know it's very, very late for people dialing in from Australia. So thank you so much. So my name is Stella Blythe. I'm a director in the CBRE Hotels and Hospitality team, and I look after capital markets across Asia, so specifically in the hotel sector. I thought it would be interesting to some of you to have a bit of an investment outlook for the APAC region, and there will be themes that obviously translate into more emerging markets in this region as well. So let's get started. So when we look at international arrivals for Asia Pacific, as you can see, top right corner over there, we're comparing sort of August year-to-date data versus this year versus 2019. And you can see that for the total, we're at about 87%. So we're 13% behind international arrivals into Asia Pacific. There are some outstanding markets like India, Japan, and Pacific, where we're actually ahead of 2019. Southeast Asia as a whole, including markets like Singapore and also Korea, we're about 10% behind. And you've got markets like Hong Kong and Taiwan that still have quite a long way to go. I mean, and of course, international arrivals is one of the key demand drivers for the hospitality industry. So it's something that we absolutely have to keep a close eye on. The other thing that we tend to look at, especially since, I guess, the pandemic, is air flight capacity. You know, how many seats in the sky do we have today versus pre-pandemic? We're still comparing to pre-pandemic. For the whole of the APAC region, we're at about 95%. So we're about 5% behind in terms of seats in the sky. But actually, when we look at last year versus this year, and we're comparing November data, we're up in most markets. So Central Asia, we're up about 12%. Southeast Asia, we're up about 10%. South Asia, 9%. And North Asia, around 6%. Down slightly in Pacific. But actually, what's interesting is when we look at the forecast of total passenger numbers over the next few years, so looking at 25, 26, 27, out of everywhere in the globe, we are seeing the biggest growth in the Asia Pacific region. So I think that's really positive for the APAC region. And this will be driven by the various markets in that region, some more established and some more emerging. So occupancy. And so, of course, you know, if we're down on international arrivals and we're down on air flight capacity, it's unsurprising that we are down and lagging in most of the markets on occupancy. So the orange line that you see is essentially our baseline, which represents September 2019 occupancy. And you can see with most markets, both 2023 and 2024, September year-to-date occupancy, we are still behind. The two exceptions to the rule, Indonesia has had phenomenal recovery, and this is driven both by domestic demand, but also international demand in markets like Bali, which we have seen just phenomenal growth in occupancy and ADR. The other market that's been really interesting to witness the recovery in is Korea. So especially this year, we're up in terms of occupancy in Korea. And, you know, Korea is a very exciting market. You have a lot of demand drivers there, whether it's sort of medical tourism or it's K-wave or corporate demand. So it's definitely a market that we should be watching. I think will continue to improve in terms of both occupancy and ADR. So moving on to average daily rate. So we have had very strong growth in 2022, in 2023, you know, we had borders reopening, we had pent-up demand. In 2024, there is still growth, but it definitely has slowed down. So the ADR growth that we are seeing is still being driven by strong demand into the APAC region, but also it's driven by limited growth in supply, which I'll touch on shortly. The other thing to note is that both owners and operators are using this sort of demand-based pricing to allow them to counteract increase in underlying operating costs and also counteract inflation. So when we're looking ahead, we're actually expecting the ADR across most markets will start to normalize, and it's actually going to be occupancy that's going to be driving our revenue for hotels. As you can see again here, the baseline is showing 2019 September, and most markets have seen substantial growth on 2019 levels. And of course, there's some exceptions to the rule, like Hong Kong, for obvious reasons, and Vietnam is coming back, but it's still had quite a bit of difficulty. And Maldives is an interesting one because in 2022 it had an outstanding year, 2021 as well. But actually, since then we've had such an influx of supply, it started to drop slightly below the 2019 point. So as I mentioned, there has been a slowdown in developments in Asia Pacific region. And, this is down to a number of factors. One, there's real lack of debt availability for development projects in our region. You also have seen construction costs rising, labor costs rising. So a lot of this has been reflected in not that very much supply coming online. What's really interesting is that for those who can sort of overcome these obstacles, they're actually looking at development in that upper upscale and luxury segment. And that's really taking advantage of the trend that we're seeing a lot more growing demand in sort of high-end hospitality. The other interesting trend that's coming out from this and speaking to a lot of developers, and I know we're going to hear from Cross Hotels later, and be interesting to hear how you see this as well. But because of the slowdown in development, we're seeing a lot of operators now focus on conversions, because operators have to grow, and this is sort of one way forward for them. This is an interesting one. We have carried out a global hotels invest intention survey at the beginning of the year, just to understand what are some of the big challenges facing investors today. So as mentioned already, escalating construction and labor costs were ranking at the very top. One example, for example, is Japan. We've seen a 30% increase in construction costs in Japan on all commercial real estate since the beginning of 2020. So that is a substantial increase. Second highest concern is elevated borrowing cost. Again, as sort of mentioned, there's lack of debt availability, and the debt that is available is quite expensive. So investors are definitely seeing this as a potential obstacle. Obviously, we have seen some rate cuts since March, since this investment survey was carried out. So we are seeing this trickle down to the borrowing costs in a lot of the markets. So hopefully going into 2025, this concern will be elevated at least slightly. Yeah. And then finally, touching on hotel investment volumes. So despite the fact that we've had very high interest rates for a longer time than we expected, and across the globe, we have seen stable activity across the APAC region. But what you can see here, it's predominantly driven by I would say less emerging markets like Japan, Australia, Korea. So Japan has been the number one market for investment across the region, and this is mainly due to being one of the only markets that has positive carry. But then we have seen quite a lot of luxury hotels transact in mainland China, although I would say most of this investment has not been sort of cross-border, it's been more domestic. Korea has been a very interesting market, again, operationally has performed so well, and we are seeing more international investors looking to buy in this market. And of course, Australia is always a very strong market, operationally, sort of a very high domestic operational support. So it's always performed really well, very transparent market as well. So it's done quite well. As you can see there, in much smaller numbers, we do have markets like India, Thailand, Indonesia, sort of more emerging markets coming in. But again, in terms of ticket size, it does sort of it is a much smaller segment of the pie when we look at the total transaction volumes. So that's it from me as an introduction. Hopefully that sets the scene for at least the Asia Pacific region, and obviously we will dive into more questions later on.
Excellent. Thank you very much, Stella. I much appreciate it. And I certainly have a question for you when we get together shortly. Okay, Trevor, I'm sorry to keep you waiting. Trevor, I'd like Trevor to lead his discussion on Africa and all countries within.
Okay, well, thank you, Ross. Hoping you can see. No, you can't see my screen. Hang on. Okay. Can I confirm you can see my screen?
Yes.
Good. Okay. Well, thank you, Ross. As you say, I'm greetings from Lagos, Nigeria, focusing on Africa, and I've chosen to present on a publication that we put together each year on what the hotel chains, the international chains and the African chains are doing in terms of development pipelines. No, they are not investors. Most of them are service providers on management agreements or some franchises. But of course, at the end of on the other side of every deal, there is an investor. So if you like, it is a proxy for investment in new hotels in Africa. At the beginning of each year, we collect information from as many chains as we can reach out to. And this year we had a record 47 hotel chains contributing with their 134 brands. 524 hotels in 41 countries out of the 54 on the continent. That's about 92,200 rooms and 9.2% growth on last year. But whilst these look like big numbers, just to put that into context, the pipeline in China, according to Logic Econometrics, the pipeline in China is 3,775 hotels, about 700,000 rooms, of which 70% are actually under construction. So that's about 500,000 rooms on site under construction in one country, China. And then and the Lodging Econometrics reckon that there's 874 hotels opening in China this year. And in the USA, the pipeline's about 6,000 rooms, hotels with just over 700,000 rooms and about 600 hotels due to open. So let's call the glass half full, lots of opportunity for more development. I've just given you data from 2 companies. We're talking 54 countries, 54 countries on mainland and the islands of Africa. This is where regionally it's happening. So the 2 big ones there are North Africa and West Africa. North Africa, almost half of the pie. But North Africa in this sample is only 4 countries. It's Morocco, Algeria, Tunisia, and Egypt. We normally count Libya as a North African country because that's where it is. But there is no pipeline signed in Libya currently. So North Africa's 4 countries, but it's 43% of the rooms in the total pipeline out of those 41 countries. So Egypt on its own, and I'll show you that in a minute, Egypt on its own accounts for 28% of the total pipeline. With Cairo, one city, one country, one continent, is 15% of the total pipeline. Quite extraordinary. West Africa is the next largest, but then West Africa actually has 18 countries counting on the map. There's 16 countries with a pipeline. And so it's no surprise that with so many capital cities, there is more happening in West Africa. Central Africa, not a lot happening. East Africa, a lot has happened in Kenya, Tanzania. So it's a lower pipeline than perhaps it has been in previous years. And there's the ranking of the countries in this sample that we put together each year. Just look again at Egypt. It's quite extraordinary that in terms of number of rooms, it's 3 times second and third place Nigeria and Morocco, more than double the number of hotels. And also look at Egypt, they're much bigger hotels than in most other markets, with the exception of Cape Verde, where you have big resort boxes on the beach. So the average size of a new hotel in Egypt is almost 250 rooms. All the North African countries are there. So you've got Egypt, Morocco, Tunisia, and Algeria. And Cape Verde, one of the smallest countries it comes in, as I said, it's got some very big beach boxes, BBBs there, big beach boxes. Ghana comes in with rather smaller hotels, or also Kenya rather smaller, and Morocco. I think that sample is brought down because there's some quite small riads in the sample. But that top 10 total of countries out of the 41, that's almost 75% of the total rooms are in these 10 countries. Countries where there is no branded pipeline tells the story about what investors are looking for. And of course, one of the main things is stability. So in here, we have countries, they're not all unstable countries. And with the exception of Sudan, they're all quite small countries. But when it comes to size and therefore investment development potential, you've got some little ones like Eswatini, Lesotho, Burundi, Central African Republic, also countries which are, well, we're supposed to be talking about emerging markets. I'm not sure some of these countries are doing much emerging at all, like Central African Republic, Eritrea. Mali, of course, has its own issues with the political instability, as has Libya. But it is interesting to see those countries where there is no branded pipeline. And in fact, there are countries here which have no branded existing hotels, like Burundi, Eritrea, Somalia. Have nothing there at all. Central African Republic, it falls into that as well. So going back to where the pipeline is, so these are the top 10 cities and resorts by number of planned hotels and rooms. Greater Cairo, because it's a great city, it is in terms of size, but way above anywhere else. Look at Lagos with 3,700 rooms, is about a quarter, so yeah, about one third of Greater Cairo. And then you have some resorts in there, and on my next slide talks about resorts. Boa Vista in Cabo Verde, Sharm el Sheikh in Egypt are two resorts which fall into there again with some quite big hotels. You can see the gap between the hotel bar and the black line shows the differential in size between that and others where they cross. So Greater Cairo, by far the largest pipeline, 15% of the total, and that's up from 12% of the total last year. There's a huge difference in the average size of hotels. 600 rooms average size in Sharm el Sheikh, 500 rooms average per resort in Boa Vista, and then Accra about 130 rooms average, the same in Casablanca.
Trevor, I'm sorry to interrupt. I was wondering whether you could. We've got time as our enemy here, sadly, and I was hoping that you might be able to finish up shortly.
I will finish up very shortly. Okay, I'll skip that one. Here's who is doing it. And again, like Egypt dominates the countries, Marriott International dominates the companies that are actually signing deals. More than double Hilton, more than double Accor, the next two, and almost 4 times Radisson. Okay, interesting that Marriott also has some fairly large hotels in there, larger than Hilton and Radisson. Of the global chains, all of them are there except for Choice, which although one of the largest global hotel chains, has yet to enter Africa at all. So to finish up, though, this is one this is one graph that I have to show, although it's a bit disappointing, because what this shows is on the blue bar is the number of hotels that the chains told me they were going to open in 2023 here on the top. But the actual number of hotels that open was only 29 out of that total 139. 21% of scheduled hotel openings actually opened, compared to 2019, where we did 75% actualization. So lots of opportunity to grow, and I'll leave you with the positive fact that so far in 2024, we're up to 25%, and I do know that some hotels will open in the last gasp of 2024. So thank you. If you want to see the full report, there's my website where you can download it from the front page. Thank you.
Thank you very much, Trevor. A lot of very, very interesting information, and I've got some questions for you shortly. I'll now call on Fanati to present, if you would, please. You'll have to unmute, I think.
Right, sorry.
Yeah.
All right, can you hear me?
Yes.
All right, sorry. Good evening, everyone. Thank you, Ross, for inviting me to be part of this panel. Basically, I'm going to present to you the perspective from an operator side. So let me share you my screen. So I'm representing Cross Hotels and Resorts. I'm Fenedy, and I'm the Director of Development for Asia. I'm mainly looking after Thailand, but also opportunistic markets within Southeast Asia. So just a little bit of information where what makes Cross Hotels and Resort different from the normal brands. We are part of the Flight Center group. So majority of the hotels would be having enterprises within the hospitality sector, but with the Cross Hotels and Resorts, we are part of one of the biggest travel companies in the world. So with Flight Center, there are 3 buckets within our parent company. One is leisure, corporate, and the supply, where Cross Hotel sits. Now, as you can see here, there's leisure and corporate. After the pandemic or during the pandemic, one of the key drivers that we are really moving forward under the Flight Center is like the meetings and events. So that's why I think it's also very important for me to share this, because one of the demand drivers that I'm going to talk about for Thailand is also about MICE market. All right, so we can talk about sustainability and etc., but being part of travel company, sustainability is actually one of the key drivers, and also needs to be part of our audit, to be part of our brand. Now, this is a general look into Thailand. So I'm going to bring you back to Asia. So with Thailand market, we are, in fact, as of November, we have reached about 31 million arrivals, international arrivals, and the target is about 40 million. But generally, the top source market for Thailand is China, Malaysia, India, South Korea, and Russian market. So these are the top 5 that has been driving most of the demand, the occupancies, and the rates for Thailand market. Now, Thailand, as you would know, is one of those markets whereby it's very reliant also with tourism. So it has about 7.24% when it comes to part of the GDP. Now, with Thailand, of course, with Bangkok as one of the key markets, we have seen that occupancy is also pushing up. So we're reaching about 75% occupancy year to date. Just in Bangkok alone, last year, we saw 55 million arrivals, and 25 million of that is from the international market. By this year, we have seen that it's already, overtaken pre-pandemic levels, and in fact, it's been very impressive when it comes to occupancy, and even for our operated hotels has surpassed 80% mark. So that's from an operator side. Now, for the market performance, another key markets that we are closely looking at would be Phuket. Now, this is quite interesting because also Phuket has exceeded the occupancy levels, pre-pandemic levels, and rates are up by almost 43%, as you would compare that to last year. Now, one of the key things that I would like to highlight in Thailand is they are pushing a lot into medical tourism and also wellness. And if you would just look into Phuket alone, they're looking at having international hospital, the expressway, and these are some of the drivers for emerging markets like Thailand. There will be also expansion, the planned expansion for the international airport. So these are just the few demand generators that makes Phuket one of kind of a hot market when it comes to also development. If you have been to Phuket probably this year, you would see a lot of developments. There are still rebrands happening, and we are also actively looking in southern Thailand, but there's also greenfield developments happening, not just in Patong area, but also in the other parts of Phuket. All right, so opportunities, I guess, of course, from a development side, we looked at opportunistic factors for a market. So one of the key things that we look at is also the MICE sector. If you would look at Bangkok, they have the Queen Sirikit Convention Center, which is at par and comparable with the MICE sector as compared to Sydney, Singapore, and even Dubai. So having an attractive MICE market and a growing MICE market also with the affordability of Thailand and also like Bangkok will also help to be one of the, I would say, the factors for making this market also attractive for future developments. That's it for me.
Excellent. Thank you very much. Thanks, man. I'll have a question for you. Do we have, is Nick with us?
I am, Ross. How are you?
Excellent. Excellent. Nick?
I've been sitting quietly and very impressed with everyone's content thus far, but thank you for having me. I do appreciate the invite. I'll share my screen as we speak. For those of you that don't know me, which I'm sure is many of you, my name's Nick Lower. And Ross, thank you very much for the introduction earlier. I form part of the Savills Hotels business here in Australia. I'm based personally out of Sydney, and today I thought I'd give you a very quick snapshot on what we're seeing here in Australia. Can you see my screen okay, everyone?
Yep.
Great.
That's it.
So I am conscious of time, so I'll get rolling. But look, for those that may not know the Australian market too well, just a quick snapshot on the understanding of things here. But we're a relatively resilient market, and I do appreciate, Ross, you giving a snapshot of the meaning behind today's emerging markets, because here in Australia we certainly see ourselves as an emerged market, but talking about things about rapid growth and improving infrastructure and the growth of the middle class, they're certainly things that we're seeing here happen quite quickly around us. Obviously, we're a small population of 27 million, but that is quickly growing. So, as I said, we're resilient and growing. There's a diverse geography here, and most of you would know the major cities being Sydney, Melbourne, and Brisbane. But COVID somewhat allowed us to explore our country and understand the different states a little bit better. And those states include cities like Adelaide, Perth, and Brisbane, which we'll touch on a little bit later. But obviously, a major key demand driver in Australia for us is obviously tourism. For those of you that may not be aware, we have a really blended mix of owners and buyers. Obviously, a strong domestic ownership throughout the country, but there's a growing rate of institutional investors looking to come into Australia, and already present. There's been a number of new funds sort of spawn over the last 3 to 5 years here. Internationally, we have a really strong presence of Southeast Asian owners, in particular Singaporean owners, as Stella would know well. Over the last probably 10 to 20 years, we have seen quite a shift in the market here. There's obviously a strong movement towards franchises from an operational point of view. A focus now on ESG, which I know we'll touch on later, and I won't bore you too much about now. And obviously an adoption of technology, which no doubt most markets are seeing as well. Just a really quick snapshot on what's happening currently. 2024 for us has been a relatively low transaction volume year. 2023 also was. But as you can see, we're only touching just over $1 billion of major transactions. Occupancy's been a really strong growth factor in our market. Stella touched on it earlier. Obviously, COVID didn't allow international visitors into our country, and that's slowly picking up with international touchdowns via airports picking up at a quite aggressive rate. This graph here over the right is just a bit of a snapshot of RevPAR for this year. Obviously, seasonally in Australia, we see a lot of activity from a domestic travel point of view in January and February, and things have started to plateau, which is a relatively normal trend. This is just a quick snapshot optically to give you a look at transaction volumes. Apologies, I'm not sure what I'm doing with the mouse by scribbling everywhere, but you'll have to forgive me. But here on the right, you see the highlighted in yellow. That's year-to-date transaction volume. So we certainly are down on previous years quite significantly. Obviously, 2020 being COVID and an expected low year. Investment trends and buyer sentiments, as you can see, we are still dominated by domestic acquisitions. Pretty much 80% of the market this year has been acquired by domestic buyers. There's only been four transactions over $90 million this year, which is a relatively low number. Fortunately for our business, we've completed 50% of those deals. Touching on a couple of key market highlights, Sydney, Melbourne, they were the major markets affected by COVID, and we still are seeing those effects. But Sydney in particular has had a strong year and seen significant RevPAR growth driven by ADR and occupancy. Brisbane, much the same, but has some major infrastructure projects going on at the moment. We're hosting the Olympics in 2032. That's had a significant effect on Brisbane itself and accelerated growth of some major infrastructure projects, but has also caused quite a few concerns in that market as well from a construction point of view. All the major builders are taking on the less risky government jobs and leaving private and some institutional developers in the lurch without builders for their projects. Perth is one of the standout stories of the last couple of years, much like markets like Adelaide and a few others. Adelaide and Perth have, at different times this year, led the entire country from an occupancy level. Certainly markets that probably need a little bit more supply, but have challenges to create it. Just touching on some of the challenges and opportunities in our market. Obviously, interest rates is a common issue globally. High borrowing costs has just slowed down activity. We are seeing some pretty major labour gaps, not just in hospitality, but throughout our employment market. Supply constraints, operational costs rising. Again, these are all global issues. ESG compliance. Probably for hotels, and in my position, I do have a bit of an oversight over a few other asset classes. They're probably taking up ESG far quicker than we are. Probably comes down to the fact that hotels, in a way, in Australia still aren't as institutionalized as they are globally, but ESG is certainly something that's now significantly in our space. But we are having a few issues from a cost point of view. Opportunities, again, tourism recovery, it's happening as we speak. We expect to surpass pre-pandemic levels towards the end of 2028. Obviously, we probably are now at the peak of interest rates, so people are a little bit more comfortable with what the next 12 to 18 months looks like. The regional markets we touched on earlier, cities like Adelaide, Brisbane, Perth, they've been real standouts over the last couple of years, and we expect those markets to continue to thrive. In a global context, and having travelled myself a little bit this year for a few different hotel conferences around the world, again, as Stella touched on in one of her great slides earlier, Australia is seen as one of those top few markets globally as a stable economy with high growth and very stable economic volatility. The interest rate easing, that's certainly going to boost investment. We certainly find that there's a lot of market appeal from the statistics around tourism growth and the population growth of Australia. As the slide suggests, we're expected to exceed 30 million people here in this country by 2030, if not sooner. But there's still a lot of opportunity. We're probably one of the few countries that have only a small proportion of operational models as franchises. That's growing quickly. And obviously, being a strategic gateway location to Asia Pacific, we continue to attract international capital. And again, something we'll touch on shortly. From a strategic point of view and opportunity point of view, we are seeing more and more conversion and value add adaptive reuse opportunities exist in our market. The reality is the office market, as a good example, is having some issues, and construction costs sitting where they are, we just can't develop fast enough. So there are some extremely exciting opportunities at play in the market to repurpose some existing buildings. So that's it for me, short and sharp, but look forward to answering some more questions shortly.
Thank you very much, Nick. I'm going to call on Daniel now, Daniel Lesser from New York. Sorry that it's so early there, Dan, but I'm going to forsake giving my 10-minute speech in relation to Indonesia and in the safe, because of timing. Anyone who wants to look at that that can do that tomorrow in a slide presentation. So it's over to you, Dan.
Good morning. Can you hear me?
Good evening.
No, good morning. Good morning.
Morning.
It's morning here in New York. And Ross, thank you so much for organizing this and inviting me to participate. It's a real pleasure and honor to be here with some esteemed folks from around the world. I have a fairly lengthy slide deck, but I'm going to go through it very quickly. And Ross, I think you said that it'll be available to all after the seminar. My contact information is on here as well if anybody is interested in getting a hold of me. My attorney always insists on a disclaimer. Basically, it says, don't believe anything I say, so take that with a grain of salt. Just kind of real high level, I'm covering the United States in this discussion, and the United States, I don't think is necessarily an emerging market. I think it's a pretty mature market, and so I think it's a good part of the world to look to for emerging markets to what they could possibly develop into. So the economy in the United States, obviously very mature and as of late fairly robust, and it looks like that's going to continue into the near term, which obviously is a big positive for the lodging industry. The travel sector in the United States and globally is also extremely has a positive outlook. If you think about it, right, people travel, they need to stay in hotels or other types of lodging accommodations. So I think COVID sort of taught the world that life could be short, and experiences are a lot more important to many these days as opposed to material goods. When we narrow down to the lodging sector in the United States, we can see that occupancies are fairly steady. There is some average rate growth, very modest. Thus, revenue per available room, or RevPAR, is also increasing, but at very modest levels. Everything's relative in life. I remember back in the early 1990s when the U.S. was going through some painful times, and hotels were losing money from an operational perspective prior to debt service, right? There definitely are challenges vis-a-vis increasing profits, increasing top-line revenues in the United States today. But at the end of the day, it's still a profitable sector, right? Whereas in the early 1990s, it was not. So again, everything is fairly relative in life. When we look at some headlines from just this past year, hotels are hot commodities in the United States, and traveling has become quite expensive. We're going to see some slides to that effect. When did a $200 hotel room start feeling like a bargain, or the rise of the $1,000 a night hotel room? So it is quite interesting how the travel sector and the lodging sector in the U.S. is doing phenomenally well. Again, on a relative basis, the public companies released earnings during the recent past, and generally speaking, it's fairly positive. There have been some companies that have been affected by labor strikes, and we're going to talk about that a little bit, as well as weather events. But those are, obviously uncontrollable, unexpected events, particularly the weather. But generally speaking, the public companies have a pretty positive outlook. I'm going to take a few minutes to talk about some strengths, weaknesses, opportunities, and threats for the sector. I'm an optimist at heart, so I'm going to finish with the opportunities and do the threats before that. Talking about strengths, Americans, they love to shop, they love to spend money, and they love to experience life. And I think it's every American's God-given right to go on vacation, whether they can afford it or not. And they're doing it en masse. There's no question about it. Business travel has come back very nicely post-COVID. So has group meeting business. I'm sure that in other parts of the world, no different than in the U.S., during COVID and as we were coming out of COVID, there was a tremendous amount of leisure traffic, particularly drive-to leisure. That's obviously tailed off now that the world has sort of rebounded from COVID, and we're back to kind of hitting on all cylinders, right? All demand segments are producing good volume for the sector. The amount of U.S. travel on airlines is achieving record levels. Just this past Thanksgiving, we had another record of folks passing through TSA screening. So again, very positive for the lodging sector. This is interesting. When you look at new supply coming in, it's fairly muted when you look on a long-term basis in the United States. Something that I find very interesting is that, particularly during COVID and still post-COVID, there are a number of hotels in the United States, particularly on both coasts, that have permanently closed and continue to permanently close for a variety of reasons. And for some reason, in other real estate asset classes, commercial real estate asset classes, they look at net new supply. And for some reason, in hotels, we only just look at new supply. We don't look at net new supply. And I think that's an important issue because, again, there have been no shortage of hotels that have permanently closed, and that obviously affects supply and demand. So something to think about. Other strengths for the sector is the availability of financing proceeds, whether it's refinancing, acquisition financing, and there's even a bit of construction financing. And I say a bit because a project needs to pencil out from a feasibility perspective, and we're going to dip into this a little bit later. But generally speaking, hotels in the United States are selling for below replacement costs. So, why would you build a hotel if you could purchase one less expensively? Obviously, that does not hold true for all markets, and new opportunities that do make sense. Financing's available. There's been a rash of mergers, acquisitions in the space, particularly amongst hotel management and brand companies. I think scale has always been important, and it continues to be important. And we're seeing a lot of M&A activity, and the expectation is for more to come during the near term. Transaction activity definitely has been somewhat slow, but it is increasing as every day goes by. There's a tremendous amount of pressure in terms of a wave of debt that's coming due on hotel properties. There's no shortage of hotels in the United States that are capital starved. We're going to talk about that later on, and need renovation. And it looks like interest rates are trailing down. So, there's definitely increased activity on the transaction side, and that is anticipated to continue into the next year as well. When we look at some of the major trades that have occurred in the United States, we've had some pretty significant transactions, whether it's the billion-dollar sale of the Hyatt Regency Orlando, the Arizona Biltmore, and the list goes on and on. So, some major significant assets that have traded for some very healthy numbers. Lots of transactions at $100 million or more. It's interesting when we look at per room sales. It used to be that $1 million per room sale was big news. Today it's news, not big news, because it's occurring a little bit more often than it has in the past. And then, of course, no shortage of trades between $500,000 and $1 million a key. So again, fairly robust pricing for trophy assets and candidly irreplaceable assets that you wouldn't build again at this point in time. When we look at the profile of who's buying hotels in the United States, this is a who's who of investment groups, many of whom are focused exclusively on the lodging sector. So I think that speaks volumes about the perceived outlook for the hotel industry and investor appetite. Moving on to weaknesses, we are starting to see some pressure vis-a-vis Americans that are characterized as being middle class and below. And although they are continuing to spend money, they are definitely, feeling some pain and thinking twice about deploying capital or savings, I should say, to travel and to spend on shopping and things like that. Americans are definitely traveling, and post-COVID are going overseas in large numbers. That's great for foreign locations. Obviously, if they're not traveling in the United States, it's not great for domestic travel. And that phenomenon is anticipated to continue, that Americans will continue to travel overseas fairly robustly. So that is a little bit of a weakness. The sort of return to office is a phenomenon that doesn't seem to be going away. When you look at the statistics of major cities in the United States, it's been hovering about 50% of folks working from home. That doesn't mean that people aren't working remotely. Obviously, lots of people are, but it affects the dynamics of corporate individual travel. which if people aren't going to the office, then people aren't coming to see them in the office. So that puts negative pressure on business travel on the one hand. On the other hand, it also puts positive pressure on group meetings and conventions because people that work together, if they're working remotely, they don't have that human connectivity and they need to get togetger more often. So we're seeing definitely positive pressure in the group segment.
Excuse me, Dan, if I can just step in here for a moment. Time is the essence. It's getting away from us, and I want to open it up to some general discussion from
Fair enough.
attendees.
Fair enough.
Yeah.
So the deck will be distributed. Labor is an issue. Costs are an issue, whether it be insurance or property taxes, which never seem to go down. I mentioned capital spending. Lots of hotels in this country are starved for renovation dollars. Lots of threats in the world, geopolitical issues around the world, and then of course we have significant divisiveness here in the United States. These are not positive issues for for the world. Unionization is a big thing in the United States, and there's nothing wrong with unionization, but all things being equal, a union hotel versus a non-union hotel, the economics of running a union hotel are more expensive than non-union, and unions are definitely very active here in the United States. There's a wave of maturities that I mentioned earlier are coming due on hotels, and we're starting to see delinquencies bubble up. That's not great for existing sponsors, but it is going to create tremendous opportunity for an enormous amount of capital that is sitting on the sidelines. Other threats, whether it be climate change, another pandemic, ransomware, et cetera, an enormous number of opportunities in the sector. I'm not going to go through each one of these, but every hotel company, every hotel operator is looking for an edge, and taking advantage of it, and then tends to be copied if it can't be trademarked, if you will. Opportunities. Let's see. I mentioned San Francisco. It's an interesting market. We can talk more about that offline if anybody's interested. It's really taking it on the chin. I do believe it's a world-class city with tremendous opportunity on a long-term basis, and smart money will be investing there. Technology. Everybody is aware that there's huge opportunities, and particularly for the lodging sector, which in the past has been very reactive and is now getting proactive in terms of creating and embracing technology. Short-term rentals, there's definitely a war going on between Airbnb and other short-term rentals in the hotel industry. Obviously, if Airbnb gets cracked down in cities like New York and Barcelona, that's a positive for the lodging sector. So I'm not going to go through the summary because I think I've used up my time. Again, the slide deck will be available, and I appreciate the invite, Ross. Thank you so much.
Thank you, Dan. I truly appreciate your contribution. I would like to open it up to general questions. Are there any of the attendees who would like to ask any of the panelists a question? Okay, if there's no one wants to answer, I'd like to ask then Stella. You can hear me, Stella. I'd be interested to know your the appetite for private equity investment in Southeast Asia, offshore private equity. I'd be interested to know whether or not there's any European or North American private equity that's looking at resort type development, resort and hotel investments in your part of the world.
Thanks, Ross. Yeah, absolutely. And look, I think one of the things we've noticed over the last sort of 5 to 10 years is that the profile of investors, especially in Southeast Asia region, has been changing. I think, if you look sort of 10 years back, it's a lot of domestic owners, it's a lot of sort of family, high net worths owning these resorts or hotels. But we are seeing a lot of different types of investors coming in, whether it's sort of pension funds or PE funds, and there's a lot more cross-border investment happening. I guess, like you pointed out, and actually in general, when we sort of look at Asia Pacific, we've kind of said the 3 sort of hot spots have been, as I said, Japan, Australia, but the third one is resorts. And a lot of the time, the resorts sit in a lot of the emerging markets, like if you can call Thailand that, Thailand, Indonesia, Maldives, again, it's a market that 10 years ago was mainly, it's the Maldivian owners, and operated by Maldivian owners. That has changed so much. You have CDL owning real estate in the Maldives. You've got multiple PE funds. So definitely the landscape is changing. I think the big strategy for PE funds over the last sort of year or two, and this has been noted throughout all the different presentations we've heard today, is sort of value add. Everyone wants to come in, they want to reposition, rebrand, and then sort of, I guess, sell in 3 to 5 years time at a much higher return. What needs to happen for this sort of strategy to be implemented? Well, you need opportunities with vacant possession, right? But you also need more certainty in terms of tenure. I think what I'm seeing a lot of the time is we have PE funds chasing opportunities in markets like Bali, and Ross would love to hear your view on Bali, but they just can't get their head around the tenure. And it's become so difficult for them to acquire in markets like Bali, and be able to sort of get approval from their investment committees when they're not sort of outright owning the land, or there's always sort of someone involved in the transactions that makes it sort of less vanilla from an ownership perspective.
Sure.
So yeah, so there's definitely interest. These markets have been performing phenomenally. I mean, Indonesia, I remember Bali was 40% up on ADR after the pandemic. You've got Phuket, as Fernando was mentioning, also as huge increase in ADR in the years that we've had. So everyone wants to be part of that operational story and operational success. A lot of these markets are still not sort of as penetrated from an international branding perspective. So that's a huge opportunity for investors as well, to bring in a partner that they know, whether it's sort of like Marriott, Accor, IHG, or one of the big guys, or maybe sort of smaller guys as well, and really drive performance, distribution, global distribution into those resorts, and drive returns. So a very long-winded answer to your question, but I think, yes, the answer is yes, definitely. PE guys are looking at emerging markets, and especially in resorts.
Excellent. Thank you very much. Trevor, can I ask you, foreign investment in Africa? I know that's an enormous question. I'd be interested to know, in terms of hotel ownership, the acquisition of existing hotels, or the development of new hotels in Africa. Where is capital coming from for an investment in the hotel sector in Africa?
Well, I think Africa 101, Ross, is never generalize about Africa.
Yeah.
We are talking 54 countries, and
Yes.
I always say there's 3 Africas. There's North Africa, there's South Africa, and then there's that big bit in the middle with about 48 other countries. Some of them very big, some of them very small, some of them very rural, some of them very urbanized. In sub-Saharan Africa generally, there is a huge absence of institutional capital. It just does not exist. So one of the challenges we face is that an awful lot of hotel development is initiated by so-called high net worth individuals. Why do I say so-called? Because sometimes if you look at their balance sheet of a high net worth individual, it's full of an awful lot of debt. And that brings with it the challenge. And there's a question on the chat there, is why the actual number of hotels being built is a lot less than those proposed. Well, here's that answer, is that there is very little, if any, institutional finance for most African countries. The exceptions would be perhaps Morocco and Egypt in North Africa, a little bit in Kenya. There's no institutional finance in big boys like Nigeria, Democratic Republic of Congo. And then, so you have the high net worth individuals. They don't always have the ability or focus to make it happen. They get into it because they know everything there is about hotel industry because they've stayed in hotels around the world. Oh boy, I mean that's a big red flag when they talk to me as a consultant. Yeah, right. And then they get into it and realize that they don't understand it. Their architect who did their house in the village doesn't understand hotels. And they also don't understand how much it's going to cost. And so many projects around Africa fall because of a lack of money. So we're constant circular arguments here, and it really actually does go back to money at the end of the day. That Africa, generalizing about Africa, never generalize about Africa, but it's not seen as um, the destination for investment outside of, say, infrastructure, energy, things like that, social capital like education and health. I mean, as an aside, Trump never went to Africa. Biden has gone once in the twilight of his presidency. So the United States isn't actually giving much attention to Africa. And then risk in Africa. There are so many opportunities, but there are so many risks. One of the biggest ones being currency devaluation, which really isn't helping anybody in terms of importing any capital or any construction materials. So there's the answer. It's
Yep.
challenge after challenge after challenge, despite the fact that the opportunities are huge.
Yeah. Okay, listen, thank you very much, Trevor. I think we've got time for two more questions. I was going to ask, and thank you for your contribution, Trevor, much appreciated. Nick, I'd be interested to seek your inside thoughts on investment in parts of Australia, emerging regional destinations, as it were, as opposed to, the major capital cities.
We've certainly seen a shift in the dynamics of investment across Australia, certainly since COVID. And the shopping list, not just for domestic purchases, but for foreign purchase in Australia, has always been Sydney, sitting at number one for very obvious reasons. It's the biggest city in the country, and it's very much a global city. And Melbourne traditionally is sat at a close second. But for those that aren't aware, there's been some quite significant taxation occurrences in that particular market, and our states are actually governed very differently state by state, and those taxation issues have made investing in Melbourne significantly difficult, especially for foreign investors. So at this point in time, unfortunately, we're seeing Melbourne drop off the shopping list almost entirely in all asset classes, and that leaves the rest of the eastern states, being Brisbane in Queensland, Adelaide in South Australia. Now, many people know of Brisbane for obvious reasons. It's one of the sunnier coast states. It's full of resorts. It's a fantastic tourism destination, but it is a limited market from an infrastructure point of view, and from a supply point of view of hotels, it also has a limited basket of opportunities. So we've very quickly sort of seen capital start to scratch their heads and think about where else they can place their money. The other obvious place in Australia is Perth, but for anyone that may not know the size of our country, you can get on a plane in Sydney and fly for 6 hours, and then you land in Perth. So it's a long way away, and for most of us, we consider it almost a different country. So the investment profile for Western Australia is very different. So we do find that foreign money in particular does want to stay on the East Coast, but with Sydney being so expensive, Melbourne being off the shopping list, Brisbane being limited in opportunities, the other opportunities are relatively unknown. Adelaide's an emerging market. It's in the south part of the country. We're seeing some fantastic results occur out of that market. Then there are some major secondary cities, places like Newcastle, which has one of the biggest ports in the world, places like Geelong, which is in Victoria. These are markets that are within an hour of a major city. They're drive markets. People are commuting there to live and relocate with their families, especially that 18 to 35-year-old working demographic. So we're seeing those markets quickly change. So from an investment profile point of view, and you talk about infrastructure, there's a lot going on in our country, especially in those secondary emerging markets, Ross. And we expect the emergence of some of these markets to not just continue, but to continue to thrive. And I think in the next 5 to 10 years, you know, when speaking to foreign capital, you'll hear them talk about states like South Australia, Tasmania, and some major secondaries.
Okay. Terrific, Nick. Much appreciated. Two quick questions. One to Fernandi. Thanks, Nick. I'd be interested to hear your thoughts on investment in regions in the northern parts of Thailand, Chiang Mai, and elsewhere. Are foreign investors a big player in the Thai resort hotel market?
Well, normally for the northern part and even from the central part, it's usually locals who are interested in investing. So local owners have been looking at expanding or buying assets in this region. So for international, maybe like private equity, so they really more like looking into resort, as Stella would say. So Phuket is one of those areas that's been like a hot market for international investors. But normally when you go to a little bit outside the normal key destinations for Thailand, then that goes for the local investors.
Okay.
But the good thing is there are international brands out there, even us. We even have a vegan retreat hotel, which, you know, one of the key challenge for the northern Thailand has been for this year was the flood. So, you know, weather has been a big challenge in the northern part, and also like the annual haze. But in terms of interest, we've seen usually local owners.
Okay, thank you. Last question to you, Dan. I hope it's been worth your while getting up so early. But what innovation or practices from a mature market could benefit emerging markets? You've heard a number of speakers from emerging markets. Given the US is seen as a benchmark in many things, what advice could you give hotel investors and developers in some of these emerging markets?
Technology is again, I mentioned it earlier. The hotel industry, unfortunately, in the past has always been very sort of reactive as opposed to proactive. If you think back during the great financial crisis, 2008, when online travel agencies came into fore, OTAs, right? And the sector was heavily challenged in terms of, you know, a recession, the Great Recession. And people weren't traveling. And the hotel industry thought that online travel agencies, OTAs, were the greatest thing since white bread and Swiss cheese, and embraced it, you know, with open arms, only to realize as time went on and you know, the economies got better, that what did we just do here? We lost control of our most precious commodity, heads and beds, right? And there's been this tussle ever since. And book direct is you know, really kind of where it's at these days. I don't think online travel agencies are going away, but it illustrates the point of you know, embracing and creating technology as opposed to ending up relying on other providers vis-a-vis technology. So looking forward, listen, COVID and the whole challenge with labor as we came out of COVID, because lots of people left the lodging industry for greener pastures, if you will. There are so many opportunities to embrace technology to, you know, whether you like it or not, embrace human labor. And
Right.
I think we're going to see more and more of that as time goes on. I mean, mobile check-in, you know, the ability, using robots for security, using robots to clean rooms, et cetera, et cetera. There are tremendous opportunities, and I think we're going to see more and more as time goes on.
Well, thank you very much, Dan. And I think, folks, it's time. We've been probably fortunate to have about 1.5 hours of fascinating conversations. I truly appreciate your inputs, everyone, all the panelists, expert panelists from all across the world. And truly appreciate all that you've done in preparing for this webinar. And I might add at this stage that we hope to organise a series of probably more in-depth webinars over the next 3 or 4 months in certain aspects of hotel investment, obviously we're directed at emerging regions. So with that, I'd like to thank once again Dr. Rezo and the Institute of Tourism for sponsoring and hosting this incredible forum. And I wish it continued success. So I thank you for your time. Safe travels, and we look forward to meeting you at a future webinar. Thank you.
Thanks, everyone.
Thank
Thank
you.
you so much,
Bye.
Ross.
Have a
It
lovely
was
Thank
evening.
you.
great. Thank you so much, all the speakers. I just want to remind you all that the recording is going to be available in the coming hours, including the biography of the speakers and the PowerPoint that they have been sharing. So actually the PowerPoints are already on the website. So the recording will be there as well, and it will remain forever. So please do share and use it. Thank you so much, everybody. And thank you so much, Ross.
My pleasure.
Look forward to work further with you.
Yes, thank you. Thank you. Be in touch. Thank you.
Thank you
Thank
so
you,
much.
everybody.
Thank you, everybody.
Bye-bye.
Have a wonderful day, evening, and night.
Mhm.
Had you